There are three financial crises hitting American households simultaneously in 2026. None of them are getting the coverage they deserve, and together they form what may be the single largest quiet wealth destroyer in modern American history. Crisis 1. Health insurance. On January 1st, 2026, the Affordable Care Act subsidies that had kept marketplace health insurance premiums affordable for millions of Americans expired. Congress failed to extend them. Monthly marketplace premiums jumped 58% from an average of $113 to $178 per month. For older Americans and those earning above 400% of the federal poverty level, $63, $80, $40 for an individual, the increases were far steeper. Nearly 6 million fewer people are covered through marketplace plans in 2026 compared to 2025. Average deductibles rose from $759 to $37. About 14% of people who enrolled in a 2026 marketplace plan didn't pay their first monthly premium. They were already uninsured by February. Crisis 2. Home insurance. The average annual home insurance premium is on track to hit $357 by year-end 2026. That's up 46% since 2021, roughly 3 times the rate of inflation. In Florida, the typical premium is approaching $8,500 per year. In California, following the Los Angeles wildfires, premiums are rising sharply again. Nearly half of home buyers and sellers in a 2026 survey reported encountering insurance problems. 21% reported a home purchase transaction fell through entirely because of insurance issues. In Louisiana, 30 to 40% of mortgage loans fail because of high home insurance costs. Crisis 3. Climate-driven uninsurability. This is the longest term and most devastating of the three. Federal Reserve Chair Jerome Powell warned in February 2025, quote, "If you fast forward 10 or 15 years, there will be regions of the country where you can't get a mortgage because you can't get insurance. And without insurance, you can't get a mortgage. And without a mortgage market, entire regions of the country stop functioning economically." Nearly $13 trillion of outstanding household mortgage debt currently relies on insurance coverage. These three crises aren't separate events. They're three manifestations of the same underlying failure. America's system for managing risk is quietly breaking apart. And the book that best explains how we got here and what this means for your household wealth was written 30 years ago. Today I'm pairing this story with Against the Gods, The Remarkable Story of Risk by Peter Bernstein, the book that traces humanity's entire relationship with uncertainty, from the ancient Greeks to modern financial derivatives, and explains why managing risk is one of the most important things any civilization can do. Welcome to Earnings Per Page, Honest Finance, No Hype. Hit subscribe. Let's get into it. First, what insurance actually is and why its failure matters. Peter Bernstein opens Against the Gods with an observation that should be obvious but rarely is. Before humans understood probability, before the mathematics of risk was invented, people had no rational framework for managing uncertainty. They prayed, they consulted oracles, they relied on fate. The invention of probability theory in the 17th century was, Bernstein argues, one of the most important developments in human history, because it allowed humans to do something unprecedented. To measure uncertainty, price it, and transfer it from people who can't bear it to institutions that can. Insurance is the practical application of that mathematical revolution. When you buy home insurance, you're not buying protection from disaster. You're transferring the financial consequence of a disaster to an institution that can absorb it without being destroyed, because that institution is pooling risk across millions of policyholders. The same principle applies to health insurance. Individual medical disasters can be financially catastrophic. Pooled across millions, they become manageable. The insurance system is, at its most fundamental level, one of the most important inventions in human history for protecting individual and household wealth. When it fails, when premiums become unaffordable, when coverage becomes unavailable, when the pool of insured shrinks, the consequences for household wealth are severe and often invisible until they are catastrophic. Lesson 1. The health insurance crisis, what it means for your wealth. Let's be precise about what the 58% premium increase actually costs real households. A family of 4 that was paying $453 per month for marketplace coverage in 2025 is now paying roughly $714 per month in 2026. That's an increase of $261 per month, Over a year, that's $332 more for the same coverage. Meanwhile, their deductible has risen from $2,759 to $3,786, meaning the first $3,786 of medical expenses are now paid entirely out of pocket before insurance kicks in. The practical consequence: millions of Americans are making one of three choices: paying significantly more for the same coverage, accepting worse coverage with higher deductibles and narrower networks, or dropping coverage entirely and hoping nothing catastrophic happens. The third choice is the most financially dangerous thing a person can do. A single hospitalization averages over $15,000 in the United States. A moderate cancer treatment costs hundreds of thousands. One uninsured medical event can wipe out years of savings or generate debt that takes decades to repay. The decision to go uninsured because premiums are too high is financially understandable in the short term and potentially catastrophic in the medium term. Lesson 2. The home insurance crisis: what it means for your wealth. Here's the aspect of the home insurance crisis that Fortune just covered this week that most people don't understand. The 30-year fixed-rate mortgage was supposed to provide stable, predictable monthly payments. Your rate is locked. Your principal is fixed. Your payment doesn't change, except two costs quietly broke that promise: property taxes, which reset annually based on assessed value, and which have risen with home prices, and insurance, which is now rising at 3 times the rate of inflation and can increase dramatically with zero notice. The hidden costs of owning a single-family home, property taxes, insurance, utilities, maintenance, now cost more than $21,000 per year nationally. Maintenance alone accounts for $808. Insurance is a growing share of that number. The deeper problem is that the 30-year fixed mortgage no longer provides the stability it once promised, because the insurance and tax obligations attached to it are volatile in ways the mortgage rate is not. A homeowner who locked in a 3% mortgage rate in 2021 may have thought they had budget certainty for 30 years. They didn't account for their annual insurance premium doubling. Lesson 3. The climate and insurability crisis. The long-term wealth destruction. This is the most important of the 3 crises and the least understood. It's also the most consequential from a Bernstein risk framework. Insurance works through pooling. The more people insured, the more the risk is spread, the more stable the system is. Climate change is undermining this pooling by concentrating risk geographically. Areas with high hurricane risk, high wildfire risk, high flood risk are becoming increasingly expensive or completely impossible to insure. When that happens, a cascade follows. Insurers exit the market. The remaining insurers raise premiums dramatically. Marginal homeowners can no longer afford insurance. They lose their mortgage. They sell or foreclose. Home values fall in the uninsurable area. The community loses wealth. Tax revenues fall. Local services decline. The area becomes less desirable. More people leave. This cascade is already happening in parts of Florida, California, and Louisiana. The Fortune article published this week directly compared it to the 2008 financial crisis, because the mechanism is similar. A systemic shock to a financial pillar, subprime mortgages in 2008, insurance availability in 2026, triggers a cascade that goes far beyond the initial problem. Jerome Powell's warning was specific and important. He wasn't speaking abstractly about climate. He was speaking as the Federal Reserve Chair about mortgage markets. Without insurance, you cannot get a mortgage. Without mortgage markets, real estate stops functioning, and $13 trillion of outstanding household mortgage debt is exposed to this risk. Lesson 4. What Bernstein says about risk management failure against the gods is not a policy book. It's a history. But Bernstein's historical framework gives us exactly the right lens for understanding these 3 crises. His central argument is that the history of risk management is the history of human progress. Every major advance in insurance, probability theory, financial mathematics represented a step forward in humanity's ability to tame uncertainty and protect individual welfare. But Bernstein also documents the failures, the moments when risk management systems broke down. The 1970s inflation that broke the actuarial assumptions of pension funds. The 1998 LTCM collapse when mathematical models failed to account for once-in-a-century events. The 2008 mortgage crisis when risk was mispriced and mispackaged. Each failure shares a common pattern: A risk management system that worked for decades became unable to handle a new class of risk that was larger, more frequent, or more correlated than historical data predicted. The 20th insurance crisis fits this pattern exactly. The actuarial tables that insurance companies built their pricing on were calibrated to historical weather patterns. Before climate change accelerated the frequency and severity of catastrophic weather events, the assumptions broke, the pricing broke. The markets are now breaking. Lesson 5. What this means practically for your household in 2026. Here's the honest, actionable section. First, health insurance. If you are currently uninsured because premiums became unaffordable, explore every available alternative before staying uninsured. Medicaid eligibility has expanded in most states. Check whether your income qualifies. Health sharing ministries are not insurance, but they can cover some large medical costs. Short-term health plans provide limited coverage at lower premiums. The worst financial decision available is carrying zero health coverage with zero savings. One hospitalization at $15,000 turns into years of debt. Second, home insurance. Shop aggressively at every renewal. Most homeowners never shop their insurance. Insurance premiums are not loyalty, rewarded. Companies often offer the best rates to new customers. Get 3 to 5 quotes annually. If your home is in a high-risk area, investigate mitigation measures that reduce premiums. Roof upgrades, storm shutters, brush clearing, flood barriers. These investments often pay for themselves in premium reductions within 2 to 3 years. Third, understand your uninsurable risk. If you're buying a home in a high-risk area, coastal Florida, wildfire-adjacent California, flood-prone Louisiana, you need to build the full cost of insurance into your ownership math before you buy. Not the current premium, the projected premium in 5 to 10 years. The hidden cost of homeownership that Fortune documented this week, $21,000 per year, needs to be your planning baseline, not the mortgage payment. Final verdict on Against the Gods. Should you read it? Yes, but as a framework book, not a how-to guide. It won't tell you what to do about the 2026 insurance crisis. It will profoundly change how you think about risk, uncertainty, and the systems that protect or fail to protect individual wealth. My rating, 9 out of 10. One of the most important finance and history books ever written. Dense in places, but the central insight that humanity's ability to manage risk is one of the most important determinants of individual and collective prosperity is more relevant in 2026 than it was when Bernstein wrote it. The triple insurance crisis of 2026 is not bad luck. It is the predictable consequence of risk management systems built for a different world, now being stress-tested by climate, policy, and economic pressures simultaneously. The households that understand this and build their financial planning around the real, current, projected cost of insurance will be significantly better positioned than those who don't. If this changed how you think about your household risk exposure, subscribe to Earnings Per Page. Next time I'm covering the Social Security 2032 deadline and what the 22% cut on the table actually means for your retirement. Drop a comment with which of the 3 insurance crises is hitting your household hardest right now. See you in the next one.